It has been a brutal couple of weeks for investors in Enphase Energy and SolarEdge. Probably trying to figure out what's going on if you're watching this video. Looking if you're a shareholder, is it time to move on before these stocks fall even more? Maybe you're thinking about buying shares if the opportunity has presented itself. I'm Jason Hall. This is The Smattering. We're going to take a closer look at what's going on with these two companies right now, come to a conclusion about whether it's a time to buy, a time to sell, or maybe just to wait. Before we do that, though, just a reminder, this video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, please go to our special link, fool.com/The Smattering. Motley Fool is going to give you its 10 best stocks to buy right now. Please check out that link after this video. All right, first of all, let's take a look at what's going on with these stocks. So this is after earnings was released from Enphase, and you can see the stock's down 13%, and we're just barely into the market being open. We're not even open a half an hour and the stock's down. SolarEdge stock is following it down. It's down about 6%. But if we go back in time, and we don't have to go back that far, if we go back in time to October 18th, so we're talking about just not even 10 days ago, on the 19th, SolarEdge pre-announced its results for the quarter. So you see both stocks are down over 30% in not even 2 weeks' time. Okay, so here's the question I'm sure you're asking. What's going on? Why are the stocks down so much? So the short version is SolarEdge pre-announced its results. Like I said, this was back on October 19th. It dropped those pre-announced results. What did it say? It said that it's planning to report next week, but it pre-announced that an expectation of revenue of $725 million at the midpoint of guidance. That's a big reduction from the $900 million midpoint of guidance that it had been expecting. We're talking a $75 million reduction. Lowered its expectation for gross margin, both on a GAAP basis and adjusted for one-time non-recurring expenses. Basically slashed its guidance across the board. All right. And of course, that brought Enphase's stock down too. These two companies, their biggest business for both of them is the panel level electronics that go on solar panels that are used to take that DC current from the sun that the solar panels make, turn it into AC alternating current that the global grids, power grids use, and manage the power from those solar panels at the same time. And they're a duopoly. They have massive market share in North America. They're both expanding aggressively in Europe and other parts of the developing world as well. Big growth stories. These have both been really big growth stories over the years. So let's circle over to Enphase. Again, Enphase just reported. So what exactly did the folks over at Enphase report that has its stock down so much? I'm going to show you straight from the results and we'll go over it together. Okay, you see right here on the screen, $551 million in revenue for the third quarter on a GAAP basis. That was down pretty substantially from the sequential quarter. $711 million in the second quarter was also a big reduction from the year-over-year period. So that's not great. But again, we kind of knew it. It was telegraphed in SolarEdge's pre-announcement that investors should pretty much expect Enphase was probably going to see the same thing. And we got that confirmation today. Again, Enphase's stock has taken a big hit. That's bringing it down in line with the decline we've seen from SolarEdge's stock. Let's talk about some good news here because it's not all bad. 47.5% gross margin. That was actually better than their guidance they gave at the end of last quarter. For the third quarter, operating expenses also came in better than expected. Operating income, roughly in line with what you could expect. Net income, again, I think a couple of things that I really want to highlight here. If we look at that net income, almost $114 million, slightly below what we saw in the year-over-year quarter, but on a significantly lower amount of revenue. So that's really good. What it's saying is that their cost structure is really delivering well, and they're leveraging their operational efficiency in a really smart manner. And I think investors should be pleased with that. So here's the big question you're probably trying to figure out right now. What do you do next? You're an Enphase investor, you own shares. Maybe you bought them earlier this year and sometime over the past year, and you're down 30%. You're down maybe even more. The stock's down a ton from the all-time high. Maybe you're a SolarEdge investor and you're trying to figure out the same thing. They've pre-announced, they've given us a little bit of a taste of what to expect. We're clearly seeing that revenues are down a lot. You're probably trying to figure out what is the smart move here. I want to highlight one more thing. I want to talk about the guidance that Enphase gave us for its fourth quarter coming up as well. And that's something to factor into thinking about how to think about what's going on with these businesses and with the industries. Revenue, it's saying for the fourth quarter, it's expecting revenue between $300 and $350 million. Again, we're coming off of a quarter where it was already down and it delivered $551 million. So again, another sequential decline in revenue. And you might think, well, now it's the fourth quarter, it's the end of the year, maybe not a lot of solar installations going on. We're getting into winter. Is that normal? Now, let's take a look at this. This is year over year. This was the fourth quarter of last year, $725 million in revenue. So we're talking about revenue basically falling in half, by more than half year over year. So what does it all mean? It means that this is a cyclical industry. We've talked about this before, the videos I've done with Tyler Crow. Say it with me. I'm going to say it again. Cyclical industry, secular tailwinds. The secular growth of renewable energy is real. That is going to continue. Demand for solar is going to continue to expand and proliferate. Costs have come down. It's competitive with fossil fuels. Technology like energy storage is starting to make it more competitive, even with some baseload power sources. So money continues to flow into it. That's the long-term trend. That's wonderful for Enphase. Same thing for SolarEdge. It carries over to SolarEdge too. The cyclical part of it is where we're seeing these pains. Interest rates have skyrocketed. There's concerns globally about the economy. This is normal. Every few years, we go through this part of the cycle. As a result, investors are able to get some pretty interesting prices for these two companies right now. I'm going to bring up one more chart that I want to share with you. I'm going all the way back to the beginning of 2019, and we're looking at price to earnings ratio for these two companies. They're both on an earnings basis, selling for significant discounts to their price to earnings ratios going back a number of years. Now, again, this is before all of the mania that we've seen over the past few years with the bubble in stock prices that we went through in 2021, the big run up that we saw with a lot of renewable energy stocks over the past year and a half or so, based on some tax incentives in the US that were really appealing. But I wanted to go back to those particular points in time, and I want to just look at a price to sales ratio. And again, the reason I want to do this is because it's a little bit useful to talk about, as these companies have added scale and gotten larger, how their valuation has normalized. So again, we see for SolarEdge, based on that price to sales ratio, now it's struggled a little bit with its margins. I think its margins are going to start bouncing back though once we get through this downturn. The stock's actually cheaper on a revenue basis than it was back in 2019. Enphase's stock, on the other hand, is very close to tripled based on that multiple. And again, that's why the stock, Enphase's stock, is up almost 1,700% since the beginning of 2019. So throwing a lot of numbers at you, talked about where we are at the cycle. What do I think? I can tell you this. These two companies are going to bounce back. The solar market is going to bounce back. And when they do, investors are going to want to own these stocks. Whether you're going to get the best price today or the best price is going to be in weeks or months ahead, I don't know. Nobody can really tell you. But I think they're both really appealing at these prices. So put it all together, looking at the valuation of these stocks, SolarEdge is starting to look pretty cheap. I think its ability to turn around and improve its margin profile is there. Enphase is certainly not as cheap, but for a reason, it's been the more profitable of the two. It's been able to hold better margins. It's been able to execute really well on its strategy in a way that delivers free cash flow. They both have incredibly strong balance sheets. The market is giving us an opportunity. Whether this is the best pricing we're going to get or we're going to see better and better value points over the next few weeks and months, I can't give you that answer, but I do think we're getting to one of those points where this is the time to think about buying these companies, building out that position, because I can promise you when the solar market recovers and returns, the cycle will turn. I can tell you it's going to happen. When that happens, you're going to want to own these stocks because they have been proven winners and they're likely to be huge winners again going forward. Whether that makes sense for your portfolio and how much is up to you individually, but I do think they're both getting super attractive right now.